Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at the actively managed exchange-traded fund focused on the U.S. cannabis and hemp sector.
If you find our talks useful, please consider subscribe, like, and comment underneath to support us. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For those unfamiliar, this particular fund is it's really designed to be a high-conviction exposure to the American cannabis ecosystem.
High conviction, meaning they're not just buying everything.
Exactly. Its mandate requires it to focus heavily on U.S. companies that get at least half their revenue from, cultivation, retail, processing, or other crucial services.
And the key thing here, I think, is that it's actively managed. So the managers aren't just sitting back and tracking an index. They are specifically hunting for growth.
Right.
And that hunt has led them straight into the multi-state operator space, the MSOs. These are really the giants of the sector.
They are. The core thesis is all about concentrated bets on the businesses that are already dominating their state markets, the ones best positioned for when or if federal regulation finally catches up.
So who are we talking about specifically?
Well, if you look at the portfolio, the top three holdings, they make up a really substantial chunk of the fund. We're talking about Trulieve Cannabis, Curaleaf Holdings, and Green Thumb Industries.
Wow.
Together, those three powerhouse MSOs make up nearly half of the entire fund's assets. They are the engines.
That concentration, it really underscores their confidence in that MSO model. But, confidence is one thing. The numbers tell a story of some pretty extreme volatility.
It truly is a story of contrast. I mean, if you just look at the short term, the picture seems bright. As of late September 2025, the year-to-date return based on net asset value was a powerful 23.7%.
Which is great.
It is. That reflects the accelerating demand and the intense news we've been seeing. However, and this is this is an industry that's been burned before. You zoom out, and the one-year return is still lagging, sitting at negative 19%.
And that drag is, it's absolutely reflected in the valuation metrics, right? This fund's portfolio PE ratio is sitting deep in the negative.
Yeah.
Something like minus 13.67.
It is.
For a lot of investors, a negative PE is just a major red flag. What are we supposed to take away from that?
This is where the context is so important. You're absolutely right. A negative PE signals that, collectively the underlying companies are not profitable. But in this specific sector, that number tells you that investors are not paying for current earnings.
They're paying for what's next.
They are paying almost purely for the anticipation of massive regulatory change. That minus 13 tells us the stocks are depressed because of the current legal problems, not because the business model itself is failing.
So the valuation reflects the law, not the market.
Precisely. And what's happening inside these companies is critical. These big MSOs, they've spent the last year implementing serious cost discipline.
Right. Closing down inefficient operations, that sort of thing.
Exactly. Optimizing supply chains. They've created real operational efficiencies. So you combine that with the regulatory relief we're expecting, and, well, those new revenues will fall directly to the bottom line. That negative PE could turn around very, very quickly.
Okay, but given that volatility and the current losses, how safe is the fund's balance sheet? Are the managers taking on a ton of risk to chase those future gains?
That's a great question. And surprisingly, the fund itself is remarkably stable. It's almost like a buffer for investors. It maintains very low bet exposure.
Right.
But what really stands out is the liquidity. The managers have allocated a huge portion of the fund, at times well over 80% of the cash to short-term treasury bills.
T-bills. That's basically just cash. Why hold such a huge war chest when the market is, clearly getting ready for a major run?
It's a strategic move, both defensive and offensive. Defensively, that liquidity is a massive hedge against the leverage you see in individual cannabis firms. If the regulatory news were to fail, the fund has a cushion.
Offensively.
Offensively, it means they have dry powder. They're ready to deploy it quickly if volatility creates a sudden buying opportunity.
That liquidity, that starts to explain the competitive moat. But there are other cannabis ETFs. What's the real differentiator here compared to, say, a cheaper passive index?
The primary advantage is absolutely that active management by Seymour Asset Management. Because they are not tied to a fixed index, they can rotate that capital quickly.
Moving into the winners and out of the laggards.
Exactly. And in a fragmented, politically driven sector like this, that's incredibly valuable. This agile approach has historically protected capital better during the sharp downturn.
And on the upside.
And maybe more importantly, allowed them to capture that explosive upside. We've seen periods where that active rotation let them significantly outperform. I think there was one incredible 3-month period where they delivered a return of over 110%.
Wow, that's huge. That tells you they can really use that volatility.
They can.
Now, for the investor looking at this, what about income? What kind of yield are they getting?
It generates a respectable 3.54% 30-day yield, which translates to about a 2.70% SE yield.
Yeah.
And considering what you're getting, that specialized exposure and active management, the 1.34% expense ratio is, I'd say, competitive.
You're paying for that expertise.
You're paying for someone to navigate a very, very complex legal landscape.
Okay, let's shift gears and look at the market signals. Because the fundamentals are one thing, but the recent price action is just screaming that something big is happening. What are the charts telling us?
The technicals point to a significant bullish breakout, a volatility expansion breakout. The shares saw a powerful surge just recently in mid-December.
Right.
They moved from in the low 20s all the way up to almost $37 in a very short time. This massive move, it forms higher highs, signaling a powerful trend reversal, especially since it's moving so far from its 52-week low, which was under $14.
A move like that, it has to have serious money behind it.
Yeah.
Is this just retail excitement, or are institutions finally piling in?
Oh, this is definitely institutional accumulation. You look at the volume as the validation, right? And the change has been dramatic.
How dramatic?
Well, historically, the average daily volume was tiny, maybe 7,000 shares. But on that key surge day in December, the volume just exploded to over 223,000 shares.
That's a spike of what, more than 30 times the average?
Yeah, that signals significant institutional inflows. It validates the strength of this move.
So the smart money is getting positioned, likely ahead of something specific.
Yeah.
Before we get to that, can we put the current price in context, especially with that reverse split earlier in the year?
That's a really important point. Yes, the year-to-date gain is 23.7% NAV, but that's post a 1-for-12 reverse split back in February. It's sort of a clean slate, but you have to remember that history.
And for investors looking for an entry point now?
For anyone looking at an entry after this big surge, the recent low, which settled just above $25, that's now a potential short-term support level if we see a pullback.
Okay, so this is it, the core thesis. Institutional money is moving in, the price is breaking out. What is the driver? What is the high-impact regulatory news fueling all this?
The sentiment is overwhelmingly bullish, and it's driven by two immediate regulatory streams. The most imminent catalyst is the widely expected reclassification of marijuana by the executive branch to Schedule III. The market is pricing this in as an immediate event.
Potentially this week.
Potentially.
Now, we hear Schedule III all the time.
Yeah.
Can we break down the real financial impact? Why is going from Schedule I to III so enormous for these companies?
It is the single most important event for their bottom line, period. The core problem for MSOs under Schedule I is the notorious Section 280E of the tax code.
Right.
Because the federal government sees cannabis as an illegal substance, 280E prevents these companies from deducting almost any normal business expenses.
So they can't deduct payroll, rent, utilities, anything like that?
Exactly. Nothing. They are paying taxes on their gross revenue, not their net profit. This often results in effective tax rates of 50%, 70%, sometimes even higher. It's why they're unprofitable despite huge sales.
So moving to Schedule III changes that?
It changes everything. It reclassifies cannabis as having medical use, which immediately exempts MSOs from 280E.
And all those cost savings we talked about earlier suddenly flow directly to net income.
That's the engine. That tax relief drives this anticipated massive margin expansion. It turns these tax-burdened businesses into, suddenly cash flow positive and potentially immensely profitable companies. It's a fundamental rewrite of the sector's economics.
And the second catalyst, which is maybe slower, but just as crucial, is the Safe Banking Act.
Correct. Schedule III solves the tax problem. Safe banking solves the financial access problem. Its passage would unlock reliable banking, credit, all the normal financial services for the sector.
Which they just don't have right now.
One expert summed it up perfectly. They said this reform moves the industry from terrible to just bad. It's harsh, but it signals the industry is finally moving past these huge legal hurdles.
So looking at the calendar, what should investors be watching for beyond the rescheduling announcement itself?
While the fund doesn't report earnings, you have to monitor the underlying MSO reports. Those will start coming in around January, February 2026.
And that's the first real look at the numbers.
That's the first tangible evidence of the economic impact of Schedule 3. We need to see if the margin expansion meets or, exceeds expectations, and continued progress on safe banking is absolutely critical to keep the momentum going.
Okay, so we have momentum, huge catalysts, institutional interest. But this isn't a sure thing. What are the main risks an investor faces right now?
The biggest immediate risk is just regulatory delays. The market has priced this in as a near certainty. But this is a bureaucratic process. It's only one step. If the announcement gets delayed by weeks or months, we could see a massive, sudden correction. The market hates uncertainty.
And the second risk is just the painful history of this sector. I mean, the volatility is extreme.
That's the vital warning. The past 5 years have been a gut-wrenching ride. The fund's worst 3-month drawdown was a painful 58.42%, and the 5-year annualized return is still negative 20.2%. You have to have a strong stomach for this trade.
So given that history, how does the fund try to manage that volatility for investors?
Well, first, you could argue those risks are somewhat priced in already through that negative PE we discussed. But second, the fund strategy is designed for this. Active management lets them rotate out of the riskiest assets if momentum stalls.
And the T-bills provide a cushion.
And those high T-bill allocations provide a huge defensive buffer against sudden downturns. They are prepared for the shockwaves this sector produces.
So pulling it all together, the valuation, the institutional volume, the Schedule 3 catalyst, the risk management,
Right.
What's the final thought on this investment thesis?
This ETF offers, I think, a uniquely diversified exposure to the U.S. cannabis market. It seems perfectly positioned for potentially explosive gains from this imminent federal reform. The price action signals that institutions believe it, making this a pretty compelling entry point ahead of what could be a multi-year upside.
And what's the time horizon? Is this a quick swing trade or a long-term hold?
You really have two viable options, I think, depending on your risk tolerance. You could treat it as a swing trade, maybe look to exit in Q1 2026 once the initial news is priced in.
Oh, right.
Or you hold it for the multi-year thesis. You wait for full federal legalization and the complete mainstreaming of the industry. Either way, the biggest headwind is finally starting to clear.
A powerful thesis, right on the cusp of major legislative change. It just shows how much capital is waiting on the sidelines for this industry to finally become legitimate. If you want more in-depth financial analysis like this, make sure you hit that subscribe button